I think the big difference is it may have mapped in terms of being a global bull market and we having done very similarly, in fact, underperformed some markets. But I think the difference is in this market, foreigners have been selling, net sellers, and locals have picked up the baton and moved on. And I think that's the big difference, that at some point in time, my thesis is that foreigners will have to return to the extent they have. And you could look back and say a lot of the, should I say, the arbitrage positions, which is where foreign selling has been happening and local arbitrage funds have picked up, has been, for instance, P notes has been at their lowest level for 7-8 years.
You can't go short in P notes now.
So, which means that foreign arbitrage funds have given way to local arbitrage funds, and that could explain a lot of the selling there, while long only players in the overseas markets have remained passive. They have not pumped in fresh money except for IPOs. So, you could, to my mind, that's what's happened, that long only players of fresh money has come into IPOs, maybe into, selectively in the markets, but arbitrage funds have moved out from there and come in here, and that explains why P note holding is at its lowest, and which also explains why markets at the end of the day have mapped the international trend, because local guys have picked up the baton.
So, what are the sweet spots in this market when benchmark indices are at an all-time high?
So, having in a sense gone against the grain by saying that the consensus doesn't hold, I think markets are smelling turnarounds in a few places. I think PSU Banks #1 spot, and as has been proved, this run may not continue because worries continue. So, the PSU Banks and the core sector, these are the two spaces I think are climbing a wall of worry. So, the wall of worry is, will NPAs get over? Will the discounts be much steeper? Let's take just the NCLT process. The first 180-day window is now coming to an end, and come December, January, expressions of interest will get converted by the resolution professional into actual firm changes of management, where the restructuring gives way to a new person coming in, where an existing person was declared a defaulter and therefore a new management had to be brought in. I suspect, because steel companies are at the heart of this restructuring, the steel space is extremely strong internationally, and therefore I think the bids will be much higher than the discounts originally feared. Banks have been providing quite aggressively. So, if one or two cases, especially bellwether cases, result in changes of management at much smaller haircuts than anticipated, you can imagine which are the sectors. Not only will the sector benefit because the capacity is now gone into stronger hands, but more importantly, the bank that has taken the haircut will start actually writing back. Now, the two big changes in the bank accounting. One is, let us say that total steel, this thing say 2 lakh crores of provisions have been made, and if they can for a moment find a 2 lakh resolution at, let us say, 1.25 crores, 1.25 lakh crores. So, at one stroke, not only does the 1.25 lakh crores start earning, because this is now going to start earning interest or get paid down as an OTS, but more importantly, where 2 lakh crores was not being accrued, suddenly 1.25 lakh crores has started getting accrued, and the liquidity returns to the asset under question. So, I think this is like a double, not whammy, but a two-way benefit to the PSU Bank, and therefore the NIM increase could be much more than just 1.25 lakh crores suggests. It's actually, so this is, I think, a number not easily factored in by the markets, and as some of these resolutions happen, I think the PSU Banks will move up much sharper than we anticipate.
So, the rally in PSU Banks, which happened because of recapitalization, do you think that is real?
Well, not because of recapitalization, actually because of the expectation of recapitalization.
Of course. I mean, markets always look forward.
Correct.
Let me put it this way.
Right.
You think A, the rally is real, and B, better days are coming. But do you think all PSU banks will go up, or the strength will only lie with 2-3 top names?
I think the 2-3 top names, because they have already indicated that good performing banks that are recognizing and moving on, or the strong banks, will be the ones by definition who recognize the problem, and those are the ones who are going to get capital. So, you are going to sort of give capital to an SBI when it may not need capital, but the need for capital, to my mind, is actually in SBI a lot lower than what people believe. So, the SBIs, the BOBs, the PNBs will get capital when they may actually not require that kind of capital, but the need for recapitalization may not be that high. The good question is, what happens to the weaker banks? Will they be in some sense sandbagged and put into the stronger banks? I hope not, I mean, I hope at some stage, there is a way to actually shrink the incremental exposure of these weak banks and in some sense quarantine them, because the reality is you can't weaken the strong guys by just putting in the weak guys in who have 17 and 18% NPAs, if you will.
So for an investor, let me start and tell me when to stop. I'll start with SBI, the go-to choice for investors.
Well, I don't want to talk stocks actually, but it's very clear. I mentioned these names as being the bellwether in the PSU, and they need to be backed clearly. I think any portfolio that today focuses on value, focuses on buying stuff at or close to book value in a space which is dominated by private sector banks at 3-4 times book or 2.5-3 times book, clearly you need to focus on the top 3-4. There's no question. I mean, you as a contrarian, more than a contrarian, now there is evidence of things happening.
Okay, what about the cozy trades? Close your eyes and buy private banks. Close your eyes and bet on a Eicher Motor or buy a Bosch. Do you think those cozy trades now will see cracks?
Well, if you really look at it, what has not changed is the recapitalization addresses the ability to lend. Does it address the mentality to lend? I don't know. So the issue is that there is a mindset which is still all pervasive, that today we've escaped a bullet because the officers kind of resolved issues, but now the next lending, if it creates the next Kingfisher or whatever, will 4 other people be slammed into the cooler, is a fear that is still all pervading. And I respect that, because when I talk to senior bankers, their question is there a way to sort of differentiate between an honest error in decision making and a downright corrupt decision? So how do you differentiate between these two? So as long as that fear remains, one good thing is that you won't have a repeat of the KFAs, hopefully. But more importantly, if the mentality to lend has not changed, the mindset still remains closeted, saying we've taken care of our issues, now sit back and wait for your pension check, then the growth doesn't come in, which is where the private sector banks continue and have not corrected, as people feared that the NBFCs who have taken up the slack in the MSME, in the corporate space, the private sector banks took up the slack in the large corporate space. The issue really here is that as long as the mentality doesn't change, the growth still comes there.
Okay. Now, Jakes, for most portfolio investors, NBFC stroke financials, they are heart of their portfolio. At least 35 to 40% currently is invested in private banks and NBFCs.
Are you sure of that?
Broadly, if I look at the portfolio allocation, it could be 30, it could be 35, because the benchmark is 35 now, broadly put.
That's as far as mutual funds are concerned, not individual portfolios.
Yeah, I'm talking about mutual funds now.
Right.
Now, mutual funds may suddenly see a huge opportunity which is coming in corporate banks. It could be PSU banks or it could be private corporate banks. What do you think they're likely to trim? Because you cannot take your exposure to financials to 50% or 60%. You'll have to sell some, you have to reduce your exposure to existing financials in order to make way for corporate banks.
So I think the point that's rightly said is, where does this new money come in? I think the first flush of wave that you saw was clearly short covering by a lot of institutions who had borrowed stock and sold because they couldn't go short on single stock futures. That short covering rally is over. Now these have settled at levels which are much higher than what they were. So for argument's sake, without talking specifics really, but if you were to take a specific one like State Bank, it went down to 240. After the rally went to 350, but has settled at 310, 320, let's say. So these are much higher bases, which indicates that people are now seeing the change. People are now seeing the trend change, if you will. In the allocation that most people will have, I think there is no way they will have to sell private sector banks to get into this. So in a sense, the differential between these two on valuation parameters will narrow.
It will narrow.
It will narrow.
Okay.
Because I do believe that some of the strong PSU banks do have the lending culture that can bring growth back to it, along with just resolution of problems. I think the smaller banks may still be a victim of the old mindset, and therefore, but I watch this space because at the end of the day, unless this credit enhancement is clearly there, money is available, people need to lend, so they should be able and willing. That's the important thing.
Jake, what I've always admired about you is that your ability to think differently. You always like to go against the crowd, and the aim there is to get it right. So in this kind of a market where we've got a lot of cheery consensus in financials, FMCG, some odd metal stocks also, how are you one should invest the Jake, sir?
Well, I'll tell you, last time we talked about how the index investing is not going to hurt people. I think index investing for a lot of people at this stage has been beneficial. Now, you could say you may not have got a three bagger, but you've got a pretty healthy growth, and portfolios are not made of three baggers alone. But if you want to get that, I think what you need to look at maybe some consumer facing names, dominant players who have not got their act and are turning. So for instance, you take high growth spaces. So high growth space, for instance, today is the aviation space.
Okay.
So there is wide disparity in valuation parameters. As a space, I'm saying every industry represents or in a sense depicts that kind of thing. So I'll give you an example of something that's happened. A USL in a good high growth space 3 years ago, United Spirits. Suddenly some triggers, liquidity needs, whatever changed, and you had the biggest 6-bagger, 7-bagger. Can this happen in other spaces? And I think that is where the contrarianism comes in. So for instance, metal space, metal space where large metal players are there. Some of them very richly valued, others are going through churn. Maybe there is a need to look at the infrastructure space, high debt spaces where people are retiring debt. I think there is an opportunity virtually in every industry where once dominant player is languishing and maybe ready for a change. I'm not saying every industry will happen. Or for instance, the PSU space. There is a big feeling that this PSU, whether with partial divestment or full divestment, is going to be a complete, repository of value. So, can some of the big infrastructure players in spaces like steel, in PSUs perform? So I'm saying every space will have one or two, and I kind of resisting the temptation while giving sort of hints as to what all spaces one could look at or where I am personally looking at. So I think have extreme. I mean, the aviation, for instance, grows at 25%. The industry is growing. Have all players performed equally? The answer is clearly no. So you need to.
Would you bet at the number 2 player or the number 3 player?
I don't want to get into this again, but I'm saying this is one way of looking at spaces that have growth, where clearly dominant players who have not performed, you need to figure out if there is some change there.